Hey everyone, welcome back to the Purpose Driven Investor Podcast. I'm your host, Robert, and today's episode is for anyone thinking beyond the single lane investing and into building a real durable wealth across cycles. Our guest today is Brad Martin. He's a seasoned real estate entrepreneur investor based in Oklahoma City, and he is the co-founder of Rev Estates, which is a luxury-focused real estate and lifestyle investment platform. Brad's experience spans across the entire investment life cycle, from acquisitions to development, operations, and disposition, across a diverse mix of asset classes, including multifamily, industrial, office, luxury short-term rentals, and even golf course. I don't think there's anything that Brad hasn't done. But what sets Brad apart is his disciplined approach to capital strategy and risk management, paired with a clear vision for creating high-performing assets that also elevate the guest and investor experience. Welcome to the show, Brad.
Hey, great to be here, Robert. Happy to join. Thanks for having me.
Yes, sir. All right. Well, let's start out and talk about your background and your evolution as an investor. Clearly, you're doing a lot today, but I'm sure that's not how it started. So let's talk about, how did you first get started into real estate?
You know, my first forte into real estate about 25, 30 years ago, I did house hacking even before I knew what that term was. So I'd gotten out of college. I was engaged to my now current wife. My buddy and I were looking at a place to live. I ended up buying a small two-bed, two-bath house. And I was like, hey, you can live with me. I'll rent out one of the rooms. And he pretty much, the going rent was about 2/3 of my mortgage payment, and he paid most of the utilities and all that. And I quickly found out, like, man, this is actually pretty cool. This guy's paying for my wife and I's house. And once we got married, we kicked him out. But for about a year and a half, he was paying for the house. So I was doing this house hacking thing that I didn't even know was a terminology or thing. And it really kind of set my eyes on real estate. Now, I didn't jump right into real estate. I was actually in the equities world. I did merger acquisitions for a Swiss bank out of Switzerland. And so that was kind of my whole forte. But I started to do a little bit more real estate. And like a lot of people probably that you talk to, you know, read Rich Dad, Poor Dad by Robert Kiyosaki. Yep. Started to figure out, wait a second, there's ways to make money in real estate passively. And started kind of going down that path. And then through life, kind of took a different turn and started buying more real estate, you know, and about $100 million later in acquisitions and funds, we're sitting here today.
That's great. So what pushed you to expand beyond just one asset class?
Yeah, you know, I really like the idea. Again, the more you read, the more you listen to, the more you study the guys that are doing this very, very well, the more they talk about diversification. And so probably like a lot of people, I bought my first single family home that I rented to other people, and then quickly realized, you know, the only way to make money on that is to really scale that. And, you know, that was something that became really hard. Or I could get into office, I could get into multifamily. So I got into multifamily, bought a couple of small apartment complexes, then bought some offices that I leased back out to other individuals, and really just figured out, you know, there's a diversification model out there, no different than my background in the equities world. When you think of a mutual fund, you know, there's a portfolio of different stocks that set up into that mutual fund. I wanted to do the same thing in the real estate sector. And so I started buying different asset classes. And my theory is, and still is that if you can underwrite a good deal and you understand how to make the math work, at the end of the day, no matter what the asset class is, if you're good at underwriting, good at managing money and putting the right teams in place, you can be profitable and successful. And so I started looking for deals. I wasn't agnostic or specific just to one deal. I was looking at deals across a portfolio. So whether it was multifamily or office or even short-term rentals and a golf course, it was, does this deal make sense? Can we make money off of it? And put the right people and structures in place to make those things profitable, and had success.
That's great. So you see yourself really as like a deal maker, right? You're obviously, you've got some knowledge in each of these different asset classes, but at the end of the day, you're probably just real good at making deals, huh?
I mean, fundamentally, I would say that's probably a good way to say it. Good at making deals, good at analyzing numbers. I'm an Excel spreadsheet nerd. I love looking at those things and seeing if we can make it make sense. And I'm also kind of, a huge Warren Buffett fan. So he's got the great saying, when everybody else is buying, I'm selling. When everybody else is selling, I'm buying. So, you start looking at different asset classes that everybody's jumping into. You start looking at compressed cap rates, you start looking at competition. And so we started to kind of be contrarian a little bit, looking at some different things that we might be able to move the needle on because we were getting great deals and we weren't competing with everybody else. And, fortunately, we've had success in that model.
That's awesome. Okay. So what do you, we talk about full cycle and seeing things go full cycle. How did, I guess, seeing your first and maybe your second deal go full life cycle change how you invest?
Yeah, I mean, it gave me a little bit of confidence for one, right? Because before a deal goes full life cycle, it's really about you think this is going to happen. Once it goes full life cycle, then now you've got proof that what you thought did happen or what you didn't plan on happened. And so that was a situation that now, as I look at investing, there's a little bit more confidence. Obviously, there's more track record that I can utilize to help, go on to the next deal. And we started syndicating deals again, even before I knew what a syndication was. And so it was a situation where, people would come to me and say, "Hey, Brad, I want to be a part of your next deal." I didn't know what an operating agreement was. And now we're talking 25 years ago. I didn't know what a private placement memorandum was. I started doing these syndicated deals. And because of that success that we brought other people along, it just helped the floodgates open to the next deal. And so it's been really fun.
Love that. Small example, but I just in the process of selling my primary house and buying a new house. And, it's not a real estate investment per se, but selling this existing house in a market that's different than, 5 years ago when you could sell a house in a day, right? Maybe really start to consider, like, as I renovate my next house, like what does that house need to be? Because there's a lot of feedback I got selling my existing house that I didn't think about 5 years ago, right? I'm like, dang.
Absolutely. I mean, you see trends change. There's some things that kind of stay constant, but, at the end of the day, it's all about learning and being, kind of attuned to what's going on in the marketplace and try to predict the marketplace a little bit too. And so, what are people looking at? You look at multifamily as a prime example. You're starting to see a lot of operators put in outside amenities, gathering spots, to have people hang out and different things that have not been there before. Even in office, same way. They're starting to build, common areas to where people can come and hang out and kind of gather, whether they work in that same office or not. So it's always about just trying to be on the forefront of what's going on in the marketplace and thinking, how can you be unique and different and add value, not only from a cash standpoint, but also from a usability standpoint.
Love that. How do you decide which asset class to pursue?
At this point, it's, we're strongly focused on short-term rental markets. We feel that market is one that is up and coming, even though it's been around for a while. It's starting to get more sophisticated. If you look at the short-term rental market, in the very beginning, it was just a guy that had a house and he rented it out to another person. What you're starting to see now is more institutionalized value when it looks at the buyer side, when you look at even the renters and what they're trying to achieve. So we're very bullish on that market for a variety of reasons. And so we're starting to really focus on that. But predominantly does it make cash flow? Does it have appreciation value? And does it have tax advantages? So when we're looking at markets and we're looking at assets, does it check those three boxes? And kind of weigh those. What is our investors looking for? Sometimes investors are, hey, I want a heavy tax advantage thing. That's a different type of asset class potentially than a heavy appreciation or a heavy cash flow thing. Also, what's the timing to success? So we kind of look at those things, excuse me, and then measure those accordingly with what our investors looking at. And so it's a very scientific approach to it, but there's not a direct answer that we say we're always looking at this one specific thing. Kind of being a generalist looking at a lot of things.
Love it. What skills, as you look at different assets, what skills transfer well across the different asset types?
Yeah, being able to underwrite deals is the biggest skill, right? I mean, that's the thing that you have to understand is how those assets make money. How do you underwrite them? What does the financing debt to equity terms look like? That is probably the largest skill. After that, then it becomes the management side. What does the management team look like? How are you managing those? Are you self-managing it? Are you hiring third parties? If you're hiring third party to manage it, what are the questions that you need to ask to get the real answer from these third parties? There's a lot of people that manage assets, whether it's multifamily, short-term rental, office, etc. How do you make sure you're finding the right manager? Or if you're doing it, how do you put the right team in place? And so there's a lot of great leadership books. There's a lot of great content out there that can kind of help you in that. I devour, and I'm so privileged and honored to be on a podcast because I devour a ton of podcasts and always trying to learn. But those two, I would say, are the things that we really try to hone in on each and every time we're looking at an asset class.
Spot on. I love that. So let's move into capital strategy and risk management. How do you think about capital structure today as you're looking at deals and talking with investors?
Yeah, I mean, today's a kind of an interesting market. Depends on the asset class, whether you're looking at doing more the traditional, syndicated deal, or you're raising outside capital and bringing that in, or you utilizing your own capital, and what kind of the debt component is to that. Right now, with debts that are hovering 7, 8, 9%, it gets very tough to make those deals underwrite, especially if you're in competitive environments like multifamily. So those are things that, for us, we looked at. We actually kind of started to pull chips off the table just because those cap rates were very compressed. The debt started to refinance out at a 4% back to an 8%. It became hard. So our newest strategy, which is counterintuitive to what most people would believe, is what we're doing now is we're buying almost everything with cash. And we feel that if we're able to raise the capital and place it in these key marquee assets with all cash, it allows us to weather some storms that we feel are on the horizon. But then it also allows us then to refinance as rates come down, and to pull some chips back off the table and distribute it back to our investors. So that's been actually a very good thing, because what we've been able to do is go into distressed sellers, not distressed assets, but distressed sellers, and offer them 70 to 65 cents on the dollar and get these unbelievable assets at a discount because they need to get out because they underwrote bad. And we've got a couple of examples that we've done over just this past year where we were able to bring in over $1.5 million in equity because we bought properties at a discount from distressed sellers. So we're always trying to evaluate, be creative. And again, I mean, there's a leverage component out there that definitely makes sense, but it's also about timing and risk tolerance. And for us, we feel right now being able to do some of the things that we're doing with little to no debt allows us to really play in this space for a long time and honestly not have to worry about the bank, but also the revenue that we make, we pay it back to our investors. So for every dollar, if you have debt, every dollar, the first dollar has to go to the bank, right? You have to pay your debts, or they take the asset. In our case, we just pay the investor. We treat them like the bank.
Yeah, that's great. I'm sure that gives you a lot of flexibility at acquisition, and then also, once you own the property too, right?
Absolutely.
Yeah.
We're able to go in a lot of different ways and make some really good deals really quickly.
That's awesome. What are some of the risks that are investors, you think that our investors are underestimating right now?
Yeah, I mean, I think there's a couple things that kind of come to mind when you look at what investors underestimate. One is the competition that's coming out there. There's a ton of people, as information like podcasts and books become more and more prevalent. You see a lot of people get into this space where they might not have a track record. It's amazing how many influencers and guys that are out there that are doing this stuff that puts deals together that underwrite them poorly, and it ends up going back to the bank. So I think from an investor standpoint, it's really knowing the operator, knowing the GP, looking at their track record and looking at how they underwrite underwrote the deal. That's a huge thing we're seeing right now. From a global standpoint, it's really looking at where the trend's going, as we talked about earlier. What are the trends looking at? Where are you able to make money? And what are the emerging trends? And are you following those? Are you able to stay really in connection to those trends and be able to be on the forefront of those? And then understanding the debt component to it. What are rates going to do? A lot of people in multifamily didn't do rate locks or rate buy downs, and that's coming back to hurt them when they're buying these assets at 3 and 4%, and then the rate adjusted to 7-8%. Were they in the right position from a cash flow standpoint to weather that storm? Unfortunately, a lot of them aren't. You're seeing a lot of them go back to the bank, or you're seeing a lot of capital calls. And so it's kind of understanding that. I don't think that honestly gets any better. I think as rates come down, you're going to see a lot of people jump back into all these various asset classes. They're going to leverage them pretty heavily because that's what everybody tells them to do. But then rates are cyclical. They're going to go back up. And then did they learn from this past 3, 4, 5 years that that's probably not the wisest thing to do?
Yep. That's good advice. All right, let's talk about Rev Estates. What problem was Rev Estates created to solve?
Yeah, the biggest problem Rev Estates was created to solve is kind of, if you look at, there's 4 main components when it comes to real estate investing, right? There's a cash flow that people want distributions, whether it's quarterly, annually, or something like that, right? There's appreciation value that people want. Does the property appreciate over time? There's also tax advantages. Are these properties going to provide tax advantages? But there's also another component, and that's a lifestyle component. We work very hard for our money. We do all these things. And so do we get to enjoy the fruits of our labor, not only with ourselves, but with our friends and our family? And so, what really set this apart for me was we had been doing short-term rentals just internally, my family and I, for a long time. And my daughter, this is 3 years ago, Taylor Swift actually came out with her Eras concert tour, right? This $1 billion concert that she just wrapped up 3 years later. But at the time, my 14-year-old daughter came to me and said, "Hey, Dad, any chance we can go see Taylor Swift's very first concert in Scottsdale, Arizona?" We were fortunate enough to own some assets in Scottsdale. So we flew to Scottsdale, saw Taylor's very first concert. We can say we were there. And my daughter got this unbelievable experience, this unbelievable moment that she and I got to share that is beyond just owning a multifamily or beyond owning a warehouse or office or anything like that. And to me, it kind of clicked, like there's a lot of people looking for that moment with their friends and their family. And at the end of the day, people are always going to want to go to the beach. They're always want to go to the mountains. Why don't we own those assets? They're going to appreciate typically at a higher clip than, standard plot of land in any town USA. So let's put this company together where, we can allow our investors to go to some of these great, unbelievable places, but the places that we own and that we're profiting from. And so fundamentally, the lifestyle component was the other thing that we added to, that mix of 3 main things that we added that people are looking for. And we've had success with it because, what good is it if you have all this money, if you can't share it and you can't make these unbelievable memories? And so we created this Rev Estates, which means dream homes in French. We created this dream opportunity for our investors to, not only get appreciation, not only get annual distributions, not only get tax advantages, but as importantly, to also get this lifestyle component.
Man, count me in. Where do you own them? What I guess you probably have them all over, but what areas, what cities?
Yeah, we're in Arizona, we're in Costa Rica, we're in Utah, we're actively looking in Turks and Caicos, Anguilla, Hawaii. All the major places, honestly, that people want to travel to, those are places that we're at. And so it's been a fun experience. Also, just because, we get to go to these places and we get to, tour them and see them, and that's a tax write-off as you're traveling there. And so it's a fun experience to take the family or take friends or investors and say, hey, let's jump on a plane and go to Turks and Caicos and go check out 3 or 4 properties.
That's wonderful. So let's say I'm an investor. How many times can I go visit the properties?
Yeah, you can go, depending on when you want to go and where you want to go, you can go 30 to 40 to 60 times a year to these properties to utilize them.
Man, that's great. I'm in. So you'll have to send me details after
yeah,
this.
Absolutely.
how do you define luxury from an investment standpoint? Is there, I'm sure you have some criteria for how you define luxury.
Yeah, I mean it's tough, right? Because luxury might mean different to each person. We kind of define it in a dollar amount. Our average home price is $3.5 million. Our average, home, it's one of those situations where we want to have proximity to the major things that you're going to that city to do. So, Costa Rica, for example, it's a beachfront property. Deer Valley, it's ski in, ski out. Hawaii, beachfront. So, you're looking at these luxury homes that our whole market is to go after the traveler that's either going to stay at a Four Seasons or Ritz-Carlton, but they're looking at taking friends or family, so they need a little bit bigger space. So it's that type of individual. So everything that we do is first class, all the way down to the hair dryers. We use Dyson products for hair dryers, Mocha Master coffee makers, fine linen sheets. It's everything that we do is first class to create this luxurious experience. What that does as well is it helps us on an ADR, average daily rate. It helps us charge a little bit more because these are the people that are okay paying $2,000 to $3,000 a night for this experience because they're used to paying something equivalent at a Four Seasons or Ritz-Carlton.
Right. Love it. That's great. All right, let's talk about market trends and cycle awareness. What are you watching most closely in today's market as you prepare for the future?
Yeah, watching, what are rates doing? What are travel, especially in our space? What are the travel trends? Where are people traveling? Where are they really starting to come? What's the development look like? So we're looking at a lot of data as it relates to the short-term rental market. We're also looking at how does AI play into this space? What are the trends that AI is bringing into the short-term rental market, all the way from efficiencies to guest experiences? We spend a lot of time really analyzing that and how can we be on the forefront of that. So if we have a guest that is staying at one of our properties, we want to know that this is the temperature the guest likes the house. This is the type of food and beverages the guest want in the house before check-in. This is how often they want the cleaners to come. These are the type of amenities they're looking for. So we can, instead of, guessing at that kind of stuff, we can be on the forefront of it. We can also help market these properties and set themselves apart in comparison to other properties. So there's a lot of data that we consume on a daily, weekly basis to really try to help look at it, from market data of, again, where people are going to really travel to. That's great because you can look at airlines and say airlines, they're usually the indicator of where success is going, because as you see more airlines going into, places or pulling out of places, they know these places are hot or those places are starting to cool down because of just the flight schedule. So we start following that very, very closely. And then we want to just kind of, wherever they're going, we want to be, because we're a global company. We have investors and we have travelers all over the world come to these places. We want to make it easy and buy in places that are easy to get to.
That's great. That sounds like the level of detail that you go through really ensures somewhat. I mean, of course, there's risk in every investment, but a safer investment.
Yeah, I mean, we try to de-risk it as much as possible, right? And one of the ways we do it is, like we talked about earlier, is by doing it with no debt. I mean, we talk about in our pitch deck, in our conversation with our investors, with future investors, we always talk about downside risk. And so we want investors to understand, and our downside risk is, the properties don't rent out. And so that just means you can go travel there more. But what it also means is I'm probably not going to knock on your door asking for a capital call because I got to figure a way to pay the bank. And so, we always want to have that conversation with investors to let them know, there's risk in anything, but typically the risk is that it's not cash flowing enough to provide debt service.
Right.
In our case, if there is no debt service, then hey, no harm, no foul. If you fundamentally, which most of our investors do, well, actually all our investors do, if you fundamentally believe they don't make any more dirt, and you own dirt in key marquee places like beachfront, ski in, ski out, etc., that dirt over time is going to appreciate. You just have to be able to stand the test of time. And so if there's market fluctuations, but you don't have any debt tied to it, you're able to stand that test of time a whole lot better than the next guy.
Got it. Yeah, 100% agree with that. All right, let's talk about your leadership. As you've gone through your career and learned a ton, different assets, different investment strategies, how has your leadership style evolved?
Yeah, a little bit more patient. Also trying to really take a deep listen to those on the team that are bringing different thoughts and different ideas. And, we have this deal in our organization where we're always trying to challenge assumptions. And so it's not, this is why we do it, because this is always the way we've done it. It's really trying to understand, what makes us successful, what makes other people successful, how are we consuming knowledge out there that we can learn from. And so it's all about, really being communicative in our approach and really making sure that everything that we do is intentional and that we're also having fun. I mean, at the end of the day, you're going to spend a lot of time with the people that you work with, and it's not always going to be, roses and rainbows, but are you on the right mission and really defining that mission? I think that's one of the things that, a lot of times, your mission is to make money, but really, as Simon Sinek says, there's kind of more of the why. Why are we doing this? What's the mission of the organization? And then how do we get there, and making sure we're all in alignment? Where in the past it wasn't that way. It was, this is how I'm going to do it because this is how I want to do it, and it's not really in alignment with the rest of the team. And so, really being intentional about that.
What mistakes did you, as you were scaling, did you make that really taught you quickly?
Yeah, I mean, it's the wrong people on the wrong team or the wrong seat on the bus. Jim Collins, Good to Great. That was something that you bring people in that are friends or family early on to help you, but you might outgrow them, or they might not have the same interest that align with you. So you bring a partner in and they're an equal partner, but you're doing 90 to 100% of the work and they're doing 10 to 0% of the work, but they got 50% of the ownership. That starts to have a tough conversation really quickly. So, defining that very early on was a mistake that I made, where I didn't define that. I didn't really bring alignment at the very beginning about roles and responsibilities, and then also holding people accountable. And it's tough to do when you have, friends or family that are involved in the business. And so it really makes, for a tough working environment. And so that's something that we've kind of rectified as we've grown and started to scale, is making sure our alignment across the organization is always there. And there are KPIs, there's key performance indicators, not only for myself, but also other partners, other team members, that we're holding each other accountable for each and every day.
That's good. Holding accountable quickly, right? And often, I think it's important,
for sure.
And then it becomes just regular part of the day, right? Part of the operation. All right, let's conclude here with the lightning round. I have 5 questions here, and love going through these and just getting some quick answers. But let's start with, what's the best deal that you've ever done?
There's been a couple of good ones. I'll give you 2 that stood out. One, I bought 640 acres of land and mineral leases that I flipped the mineral leases where we got a leasehold. Also got to keep the land. The mineral leases paid for the land. Just selling the leases paid for the land 3 times over. Then the land was able to generate additional income. That was a pretty good one.
That's huge.
We also I bought a short-term rental property that we spent about $400 a square foot on. We had someone come and rent it and said they wanted it within 3 months of us purchasing it. We told them no, because we didn't want to pay short-term capital gains. He kept asking us. We made just a stupid ask, and he accepted it. And one of the conditions was we had to close in 366 days from purchase, so we didn't pay short-term capital. He had to put down a large earnest money deposit, which he did, that if he backed out, we got to keep. And that deal closed, and it was a very, very big, quick win. So those 2 kind of come together.
Yeah, that's great. You love those.
Yeah.
You probably wish you still owned it, though, right?
I honestly do. Yeah. Yeah.
That's how that happens.
It's a good property.
All right. What's the toughest lesson that you've learned in your career so far?
It kind of goes back to what we talked about earlier. I mean, bringing the wrong people on the team, it's hard because they're typically friends or typically family that you have to have a tough conversation with and just say our interest in this project aren't aligned. Maybe we're still friends on, a social level, but from a business standpoint, our interests aren't aligned. And so having that conversation is tough. And that would probably be the short answer there.
Yep. That's the truth. All right. One metric you're always paying attention to.
Yeah, cash flow, free cash flow. Always looking at, how are we doing from a number standpoint? How's our cash flow? Are we up, down, or, year over year? What does the trends look like? That's something that always looking at it is free cash flow. After everything is said and done, what does the cash look like in the bank?
One habit that keeps you sharp.
Yeah, consuming knowledge. I mean, I was not this person in school. I hated reading. I hated anything having to do with that kind of stuff. But I've become, maybe as I've gotten older and wiser, more gray hair. Man, like I said, I read a ton of books. I listen to a ton of podcasts. I'm always trying to consume knowledge because there's so much great knowledge out there. And that is something that has really helped me as I've gone down this journey, is to, have other people's ideas that are not my own and say, man, they did this and they did it well. I want to be like them.
Last question here. What does purpose-driven investing mean to you?
Yeah, it means that I get to do what I want, when I want, with whom I want. And that's been the goal, right? Is for all of us that are working very, very hard, spending hours on the phone, hours in meetings, hours underwriting deals, is what's the net result? And the net result is, I'm going to do hard, whether it's hard working for someone else or hard working for myself. And I choose to work for myself. And for that, I want to have this great lifestyle that I can share with my friends and my family. And, the purpose-driven side of it is, how do I give back to those? And how do I better other people's lives? And that's what we're trying to do each and every day.
That's powerful. Love that. Well, hey, Brad, I appreciate you joining. If the listeners want to reach out to you and have a further conversation with you about Rev Estates or about real estate or about life, how can they get in contact with you?
Yeah, I'm on all the social media channels. Brad at rev-estates.com is the email address. If you just type in Rev Estates, you're going to find us somewhere. And so always happy. I mean, I love these conversations, love talking to people about investing. And Robert, thanks so much for having me on today.
All right. Well, I appreciate you joining. And for those that are listening, if you're serious about investing across different asset classes or enjoying the asset that you're investing in, I'd encourage you to reach out to Brad at Rev Estates. And again, Brad, really appreciate you joining. Thanks so much.
Hey, thank you. Great talking.